Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
What's up, guys? What's going on? Thanks for checking out Private Lenders Podcast. As always, Chris and Jason are here. We got some cool stuff to talk about. Quick announcement. As we're getting started here, we are doing our first in-person mastermind meeting in a long time here in November, on November 3rd and 4th here in Columbia, Maryland. If you are interested in attending and want to apply, check out hardmoneymastermindinnercircle.com. After you schedule an appointment, you can also speak with our program director, Dave. He'll walk you through all the details, anything that's not on the site itself. So check it out, hardmoneymastermindinnercircle.com. All right. Today we're talking about loan default remedies. What are the numerous ways, there are a few of them we're going to go through, in which you can cure a loan default on a private hard money real estate loan? What we all do, right? You're about to talk, so that's not.
No problem. Yeah, so obviously when you do a loan to begin with, you don't expect that loan to default. And, you know, a lot of the stuff that we've talked about inside the Mastermind group, on our podcast and things like that, are related to underwriting. And when we are originating loans, we're making sure that they are good quality loans, because the last thing you want is a deal to default. You don't really even want a borrower to miss payments, right? That's still a headache. You know, the goal of this business is to lend your own money or other capital investors' money out and get a good, solid rate of return that ends up being passive, and that you don't have to, to work too hard for. So that being said, you know, no matter what, it's just inevitable that some percentage of your loans will eventually go sideways for one reason or the other, and you want to make sure you're properly protected through your loan documents. So when that does happen, you can go and collect on the debt and proactively figure out a way to, recoup the funds that are owed to you.
Yeah, totally. If you do enough loans, eventually you'll have a default, right? And hopefully not too many at a very low percentage, but like if you do enough loans, you'll eventually get there. It's just statistics, right? So the things that you can do to remedy a loan default are defined by your loan documents. So we are secured real estate lenders, right? So we have a mortgage or a deed of trust on a piece of property. We know the value of it. I know I'm telling you guys all stuff that you already know, but I'm getting to a point. We have a note that defines how much it is they owe us, right? Principal, interest, late fees, everything else, attorney's fees. We have a personal guarantee because we don't do non-recourse loans. On occasion in the past we have, but 99% of the time there's a personal guarantee. That's defined either in the note or in the guarantee agreement. It all describes the various ways in which we can attempt to recollect what's owed to us. Okay, so starting with the process, just practically speaking, anybody who gets into default technically may or may not be a real default, right? Like say you have a good customer, a good borrower who, has rehabbed a property and he's getting ready to sell it and it's on the market and he runs short on cash, right? Because he put X amount into the rehab and he's been carrying payments for a bunch of, ran out of cash, right? And say he's like, all right, I'm on the market, everything's done. At this point, your loan's probably at 50% loan to value or something. So you don't have to default a good borrower like that. If it's going to be like, it's going to run for 2 or 3 or 4 months, you get paid when he sells, fine. Especially on a good customer, we probably won't even switch it to the default rate, right? It'll pick up some late fees and the regular interest rate, the regular like 12.99 instead of 24. And that's fine. That's a business decision. No problem. If we're talking about our default process, so we have a monthly default meeting where we're all everyone's looking at their own portfolio, each loan originator and us. And we make business decisions like this, right? Do we need to default this one or not? And then I work with the attorneys based on what we decide to do. So step one, after letting somebody ride, would be to communicate with them and try to encourage them to cure the default, right? Like we do a bit of reach out, usually by the loan originator, trying to get them to cure. In essence, they play good cop and I'll play bad cop, right? And that's what we call it. It's their client, their relationship, people that they may or may not want to lend to again in the future, but usually they do. And they'll play good cop on that, right? And they'll be like, yeah, the attorneys and Chris, my business partner, he's gonna default this if you don't catch up, right? Like that sort of conversation. And then say we decide to do so. So the first thing we do is I keep a spreadsheet for the default meeting. And if somebody's getting a default letter, I go in and I change the interest rate to the default rate. I adjust the servicing fees that we have for whoever funded the loan. And I add on the attorney's fees into the charge. So it all hits the payoff statement. And then I send the payoff statement to the attorney and say, please do a default letter on this 1 or 2 loans. And they get it by email and by certified mail. So it's pretty sure they got it. Sometimes they ignore it. Sometimes they reach out right away. Like whatever we say to them, our team carries about 30% as much weight as getting a letter from an attorney. This, with most people, this wakes them up, makes them respond to you, and come up with some kind of plan.
Yeah, and like Chris said, it's up to you if you want to default somebody or not. Let's talk a little bit about what the term default means. So a borrower could miss payments. They could be behind payments. They could be over the loan term. Maybe they had a tax bill due and they didn't complete the construction project. Maybe they had a tax bill or an insurance bill due and they didn't pay that. Anything that kind of jeopardizes or they're in default in the transaction based on what the individual note says, you could. Most of the time we don't default people. We like Chris mentioned, we have a conversation with them and we make a business decision of what makes the most sense. I'll give you an example. Let's say a loan is due on September 1st and it matures on September 1st and they just finished the renovation. It took them a while and the property was just listed. Well, chances are you can give them some sort of an extension or do some sort of modification. There's no need to default and pursue a foreclosure if they're in the process of performing anyways. You want these loans to perform, right? Also keep in mind, when you lend money to sophisticated real estate investors, you typically will do this over and over and over with the same borrowers. That's how you grow your book of business and for referrals and things like that. So you don't want to go out there and have a bad rap of like, hey, you're just trying to foreclose on my property. You're just trying to default me. You're trying to just, whatever, get as many junk fees out of me as you can. So again, you want to protect your interest and your capital investors' interests, but at the same time, you want to make a business decision of what makes the most sense to do so. Someone misses a payment here and there. They're over the loan term. Maybe the construction project stalled a little bit. That's fine. As long as they're communicating with you. Communication's key. If they've ghosted you, it's time to default immediately. Yeah, the process in most states doesn't happen overnight anyways. So it doesn't hurt to get the process going and started. And if they're not communicating with you, it's fine. I mean, there's deals where the project went severely over the time frame. They reached out to us. They say, hey, can I make partial payments? I don't have the money to make all the payments right now, but I want to communicate with you. I'll update you every few weeks. Okay. If we're comfortable with that situation, it's something we're comfortable with. We're willing to do that, and there's others that, month 2, we haven't heard from them and they didn't start the construction job. Nobody can get them on the phone for some reason. That usually doesn't happen. Usually during your underwriting process, if you master understanding characteristics of borrowers up front, when you're doing your underwriting, that should never happen. But if that does happen, full force. And like what Chris said, soon as the default process starts, you send out an attorney letter via email and certified mail. You're going to get their attention, right? We have one right now that the guy hasn't made payments for 5 months. We've been reaching out to him every week or so and be like, yo, you keep telling me you're making payments and you haven't. Oh, I promise I'm going to have them in. I promise I'm going to have them in. I'm going to do this. Like, enough is enough. He got hit hard with an attorney letter and he reached out to be like, why'd you send me an attorney letter? I told you I was going to work with you guys. I told you.
Well, then you tried to blame it on us.
Yeah.
I tried to blame his default on us.
He reached out to everybody in the office and said, hey, I told you I was going to make good on this. Well, this has been going on for 5 months and you haven't made a payment. If you want to make good on it, bring a payment in.
He said, this is how you guys do business. I was like, all right, man, come on.
So that's fine. That's whatever. You gotta listen. We're all protecting your investor capital is the most important thing, right? That's more important than a good borrower client. But you should at the same time, make sure everybody's happy.
You got to manage both. You got to manage
Yeah.
expectations and make the best business decisions you can on both ends, for sure. There are some capital investors that'll be like, oh, he missed a payment, switch it to the default rate. I want to collect on default rate, sort of thing. And we heard that a little bit early on. And then we let people know that, like, okay, not every single missed payment is boom default rate. It's just not. Because in this business, like, that could happen sometimes. They're still a good client. We want to lend to them again. We don't want to hammer them because they're a week over the loan term, right? Like, make a business decision, manage expectations on both ends, and do the best you can. Do the best you can with what's right. Okay, moving on down the line in terms of default remedies. So we already had default letter. That's step number one. Step number two is foreclosure. And based on the jurisdiction where you are, it might be start a foreclosure and that's its own action separate from a judgment, or it could be file a judgment and then foreclose on that judgment against this property. Like, we lend in jurisdictions where it works both ways. So in Maryland, for example, the judgment and the foreclosure are going to be separate actions. In Pennsylvania, specifically Philadelphia, they're combined into one action. So you make a judgment decision about the judgment. If you want to foreclose, or if you want to do the judgment as well, sometimes, like, you might want to, oftentimes you don't, and you start the foreclosure process. In Maryland now, on investment properties, I want to say maybe it's like 6 or 7 or 8 months, something right around there, to start the process and get to an auction sale. Rarely do we get to an auction sale. I think we might have one this year on a couple properties in New Jersey, because that bar is really MIA. But it is super rare. It's common for us to send default letters. It's even common for us to start the foreclosure process. It is really rare that we get very far into it. They end up selling. They end up maybe refinancing. They sell another property, pay off in cash. Like, we don't often get far into it. And those are what we call good defaults. That's a fine exit. It's a fine exit. You get paid off in full. You get the attorney's fees paid by the borrower. It's tacked on. You don't pay those. We don't pay those unless something really goes wrong, which is very rare. And so you usually don't get that far into it. And that's cool, right? If you do get all the way to a sheriff sale or auction sale, then you do your numbers, you do an inspection as best you can, see what that property, get the best estimate of what that property is going to sell for at auction sale, right? And that's your opening bid. And there's a good chance, if you did your underwriting right, somebody is going to buy it for more than what you're owed. That's the goal. If that happens, cool. There's a process of accounting and everything else, and a settlement later on, somebody buys it, you're paid off, hopefully in full, and you're out. If nobody wants to pay as much as what you're owed, you might end up owning it. And again, this is super rare. This is like a once every 5 years thing for us, or something like that. Might end up owning it. Nobody wanted to buy it. It goes back to the lender. And then you got to deal with the property itself and all kinds of other stuff. Don't want to get too far into that specific thing. So that's foreclosure, and what can happen potentially. Hopefully you don't get there. It's rare that we do, or that you should. And then let's talk about judgment real quick too.
Let me mention. Let me mention one other thing. When you're underwriting some of these deals, one kind of stress test you got to put in place is what would happen if you had to take back this property, or if the deal defaulted immediately, right? They didn't start the construction, or maybe they finished the construction, and what your exposure is there. You got to work backwards to see what these numbers are. I remember back in the day, people are like, oh yeah, I understand what hard money is. You'll just, lend on the property, and, you'll lend whatever you're willing to buy the property for. And, it's like a loan to own strategy. Loan to own strategy is not a great thing to look at, because by the time you get a property back, you're not going to have it back at the numbers you want. The reason we lend at 65% and we always have 65%, 35% equity in these deals is, if a deal starts going sideways, it'll eat pretty much all of that equity up, or damn near close to it. So the important part of it is to make sure, you're writing good loans on the front end. And again, I don't want that to scare you that if a deal defaults, like you're going to get wiped out, because you're not. But at the same time, you got to make sure you're protected. So if a deal goes really bad, let's say they file bankruptcy, you have to fight that. Then you have to file a foreclosure. Then you have to come in, pay their property taxes, pay their insurance, things like that. Worst case, you should still be covered. Also, before you start talking about judgments, Chris, if you're listening to this on Apple iTunes, we certainly appreciate if you'd share this with a friend that might enjoy this episode, along with a quick review. And if you're watching this on YouTube, because we also do this podcast on YouTube via video, make sure to click on the red subscribe button and you'll get a notification when we release new videos like this. So hopefully you're enjoying these types of podcasts that we're doing.
Good call. We could use some more referrals and subscribes and reviews too. So, all right, finishing up on a couple default related things. So next is judgment, and judgment's what you can get because you have the personal guarantee in your loan documents, right? Full recourse loan. And there's different ways you could use this. One strategy that I like if you want to use a judgment when you're trying to squeeze somebody out of a deal who has defaulted is that if you record that judgment in the jurisdiction where the property is, and hopefully this borrower has other properties in that area, and it's only in the jurisdiction, I'm pretty sure, meaning like usually the county or a city if it's a city. If they have other real estate transactions going on, a judgment search will bring up your judgment, and they can't sell, like say you're foreclosing on property A and they're looking to sell property B, your judgment's going to pop up and the title company's going to be like, hey, we got to get a payoff on this judgment in order to sell your property. So you can use it strategically like that. That use of it, I do like. What's going to be not as it's also effective if you end up getting through a sheriff sale and maybe you weren't paid in full, or an auction sale and you weren't paid in full and you want to collect like a balance via judgment. That is possible too. It tends to be not the best remedy. You're going to have attorney's fees there. They can easily fight it. Interrogatories and all that stuff is not a great thing to go through. So like actually collecting on a judgment, not my favorite thing to do. Right. So anyway, sorry, I got some messages popping up and this and that. Got distracted for a second. And then one other part of it is bankruptcy. So borrowers can use bankruptcy. They're well-known it's a well-known strategy in real estate. If somebody has some kind of foreclosure going on, they could stall it with a bankruptcy. All they have to do is file one piece of paper or one form online, either with an attorney or without, and they can push you back for months. They immediately stay the foreclosure, and now we got to talk about a bankruptcy case, right? Total stall tactic. Usually, they're usually not bankrupt in what like you would consider that normal sense of the term. They're usually using it as a stall tactic. Bankruptcy attorneys, they file some stuff, but it's just going to take months. It's like, yeah, we could talk about what you guys want to talk about, and the bankruptcy case says to court in 60 days. And you're like, great, I had a foreclosure auction sale scheduled, and now they just get 60, 90 days for free to figure something out. Hopefully they use that time to exit in a wise way. That's not even a bad result for a lender to be in. And then there's some times where people actually refuse to sell the property. They don't have a good exit strategy. They want to ask for some 5-year pay plan to pay your loan back, which was probably a year term to begin with. So those aren't the best, and they drag out, and the court tends to give them a plan if they put together a decent one, but then sometimes they default on their own plan, which we saw happen once this year. Seriously. So long story short, bankruptcy could be involved. It could be involved. I don't want to get too deep in the weeds on that one. I honestly know more about it than I should. After being in this years, for being in this business for 15 years and several thousand loans. Anyway, we wanted to jump in on this topic. We saw some chatter in the Mastermind and hardmoneymastermind.com about this thing, the different sorts of things you would do if somebody gets close to a default. And that's basically us down the line of what you do first and second and third. Is probably about 5 different items we just covered there. All good stuff to know. Hopefully you don't need to use it or need to use it often, but we hope that you learned some stuff here today on the Private Lenders Podcast. And again, if you do want to take it to the next level, check out hardmoneymastermindinnercircle.com. Learn about the meeting that we're having here on November 3rd and 4th. And we hope to see you guys inside the Mastermind group.
Take care, guys.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private